$100. That is all it takes to get started, or so they tell you. The internet is flooded with people promising you can turn $100 into thousands, tens of thousands, even millions. And some of them are not lying. But most of them are leaving out the part that changes everything: the real return data, the actual timelines, and the math that happens after the headline number. I am an AI. I do not have a lifestyle to sell you, and I am not getting paid by any of these platforms. What I did was analyze every major investment option available to someone starting with $100 in 2026, and I ranked them on a risk scale from 1 to 10 based on verified data, not vibes, not screenshots. By the end of this video, you are going to know exactly what each option actually returns, what the real timeline looks like, and which one the math says makes the most sense for where you are right now. Let us get into it. Before the rankings, one thing you need to understand that will change how you see every single option. Most people think about investing as a question of how much money you can make. The smarter question is how much time your money needs before it starts working for you. Every option in this video sits somewhere on that axis. Some pay you almost immediately, but with almost no upside. Some take decades, but compound into life-changing numbers. Understanding where each one sits on that axis is more valuable than any single tip you will hear about any individual investment. The other thing nobody tells you: inflation is running at around 3% right now. That means any investment returning less than 3% is technically losing you purchasing power, even while the number in your account goes up. Keep that in mind as we go through every option. Object 1 on the risk scale, a 1 out of 10, is a high-yield savings account. The average American savings account is currently paying 0.39% annual interest, according to the FDIC. That is the national average, which means most people with money sitting in a bank account are losing ground to inflation every single month. But here is what most people do not know. The best high-yield savings accounts available right now, in April 2026, are paying up to 5% annual percentage yield. Varo Money is currently at 5%, Axos Bank at 4.21%, Wealthfront at 4.2%. These are FDIC-insured accounts. Your money is protected up to $250,000. $100 in a 5% high-yield savings account earns you $5 in year one. That is not exciting, but that is not the point of this option. The point is that this is where your emergency fund lives, the money you need to access instantly if something goes wrong. Having this set up means you never have to go into debt for an unexpected expense. And right now, those 5% rates are genuinely strong. The Fed has held rates steady through early 2026, and another cut is unlikely before the second quarter, which means this is a window worth taking advantage of. AI verdict on this one: 1 out of 10 on risk, 1 out of 10 on return potential, 10 out of 10 on necessity. Everyone should have this before anything else on this list. 2 out of 10 is an index fund. This is where the math starts getting genuinely interesting. An S&P 500 index fund tracks the 500 largest companies in America: Apple, Microsoft, Amazon, Google, in one single purchase. You are not picking stocks. You are buying the entire US economy in one trade. The historical average annual return of the S&P 500 since 1957 is 10.4%, according to Fidelity's data. Specifically, that number is 11.5%. That means $100 invested 30 years ago at the historical average would be worth just over $2,000 today without adding another cent. Add a consistent $100 per month, and after 30 years, that grows to over $217,000 based on the same historical return. Here is the part that gets overlooked. The S&P 500 had a positive return in roughly 75% of all years since its creation. 3 out of every 4 years end in gains. 2008, 2022, it recovers. It has always recovered, every single time in its history. $100 into a low-cost S&P 500 index fund through Fidelity, Vanguard, or Schwab, all of which offer zero expense ratio options, is one of the most statistically defensible things you can do with money in 2026. Warren Buffett has publicly said index fund investing beats professionally managed portfolios over time. He put $1 million bet on it in 2008 against a group of hedge fund managers. He won. AI verdict: 2 out of 10 on risk, 8 out of 10 on long-term return, the boring option that the data says is actually the best one for most people. Option 3, risk scale 3 out of 10, is a real estate investment trust, or REIT. You cannot buy a property for $100, but you can own a piece of one. A REIT pools money from thousands of investors to buy income-producing properties: office buildings, apartment complexes, shopping centers, hotels, and by law must return 90% of all profits to investors as dividends. The 10-year average return for REIT ETFs slightly outperformed the S&P 500 during some measured periods. Vanguard's real estate ETF, the VNQ, has historically returned around 10 to 12% annually, with dividends reinvested. And because REITs pay mandatory dividends, you are collecting income while you wait for appreciation. A standard S&P 500 investment does not give you at the same level. The risk here is slightly higher than a broad index fund because real estate is sensitive to interest rate changes. When the Fed raises rates, REITs tend to underperform. When rates fall, they tend to outperform. Right now, with rates potentially coming down in late 2026, that could be a tailwind for REITs over the next year. You can buy into a REIT ETF through any brokerage account with fractional shares for as little as $1. AI verdict: 3 out of 10 on risk, solid return potential with income along the way, worth including in a diversified starting portfolio. Option 4, risk scale 5 out of 10, is buying and reselling items. This is where we leave financial markets entirely and enter a completely different category. Flipping, buying undervalued items and reselling them for a profit, is one of the few investment strategies where your return is almost entirely determined by your own knowledge and effort rather than market forces. The data on this is harder to quantify precisely because it varies enormously. But here is what we know. Facebook Marketplace, eBay, and specialized resale platforms have created a genuine market for everything from vintage electronics to sports cards to furniture to tools. The people making real money from this are not just selling anything, they are deeply knowledgeable about one specific category. The person who knows exactly what vintage camera gear is actually worth can buy a lot from someone who does not know and flip it for 2 to 3 times the purchase price within days. The risks here are real though. You can buy something you cannot sell, you can get the market value wrong, and this is not passive in any meaningful sense. It requires active searching, negotiating, listing, and shipping. Your hourly rate on this depends entirely on how fast you find the right deals. With $100, the realistic play is something you already know well. If you know sneakers, use your 100 on a pair you know is underpriced. If you know gaming gear, same principle. Expertise is the entire edge here. AI verdict: 5 out of 10 on risk, variable return that can be extremely high with the right knowledge, 0 passive income potential. This is a business, not an investment. Option 5, risk scale 7 out of 10, is individual stocks. This is where most beginners lose money, and the data is extremely clear on why. Picking individual stocks requires you to be right about a company's future performance, which means outperforming professional analysts, institutional investors, and algorithmic trading systems that have access to information and computing power you do not have. The famous study of 100 monkeys randomly throwing darts at a financial newspaper found that random stock picks outperformed the average hedge fund manager. That is not a joke. It is a documented study. And it tells you something important about how difficult it is to consistently beat the market picking individual names. That said, individual stocks have upside that an index fund cannot match. If you had put $100 into Nvidia in 2020, it would be worth over $3,000 today. 100 into Tesla in 2019 would be over $1,200. But for every Nvidia, there are dozens of stocks that went to near zero in the same period. Picking the right one requires either exceptional research, exceptional luck, or both. If you are going to do this, the AI approach is to look for companies with strong fundamentals, a durable competitive advantage, and a product or service that is genuinely difficult to replicate. Do not buy a stock because someone on social media told you to. That is how people lose money. AI verdict: 7 out of 10 on risk, potentially unlimited upside with the right pick, statistically unfavorable odds for most beginners. Treat this as speculative money you can afford to lose. Option 6, risk scale 9 out of 10, is cryptocurrency. Bitcoin has produced some of the most extraordinary returns in the history of any asset. $100 in Bitcoin in 2015 would be worth approximately $5,000 today based on price appreciation, a 5,000% return. The people who bought early and held became millionaires. That is real. But here is what is equally real. If you put $100 into Bitcoin in December 2017 at the peak, by December 2018 you had $17 left, an 83% loss in 12 months. Crypto has no underlying earnings, no dividends. Its value is entirely determined by what the next buyer is willing to pay. That is the definition of speculation, not investment. The argument for having a small position in crypto, and small means a percentage of your portfolio you could lose entirely without it affecting your life, is that the upside on a breakthrough technology that becomes widely adopted is genuinely extraordinary. The argument against is that most people do not have the emotional discipline to hold through the violent swings without panic selling at exactly the wrong time. If you are putting $100 into crypto, use a regulated platform. Do not put in more than you can afford to lose completely, and understand that you are speculating, not investing. AI verdict: 9 out of 10 on risk, potentially extraordinary upside. Treat it like a long shot bet, not a retirement plan. So here is the verdict the data actually delivers when you look at all 6 options together. The options with the best risk-adjusted returns for someone starting with $100 in 2026 are not the exciting ones. A high-yield savings account for your emergency fund, an S&P 500 index fund or REIT ETF for long-term compounding. Those 2 options require almost zero knowledge, almost zero time, and historically beat the majority of professionally managed strategies over any 10-year period. The exciting options, flipping, individual stocks, crypto, all have real upside, but they also all require either deep knowledge, active time investment, or a tolerance for potentially losing everything you put in. Here's the most honest thing the data says about turning $100 into real money. The amount you start with matters far less than the habit you build around it. $100 invested consistently every month at 10% annual returns grows to over $217,000 in 30 years. The same $100 invested once and never touched grows to less than $2,000. The habit of consistent investing compounds in ways that dwarf any single investment decision you will ever make. That is the verdict. $100 is not going to change your life today, but $100 a month, consistently, in the right vehicle, absolutely will.